Welcome to the Deep Dive. We're here to cut through the noise and get you truly well informed.
That's the goal.
And today, you've handed us a really fascinating stack of sources. We're looking at the integrated freight and logistics sector, specifically zeroing in on three key players: UPS, C.H. Robinson Worldwide, and FedEx.
The big ones.
Exactly. Our mission today: extract those vital nuggets of knowledge, give you that shortcut to understanding what's really driving these companies right now.
And what's great is we'll be looking at them from, well, multiple angles. Basic company stuff, technical analysis.
Charts.
Right, the charts. Plus recent news, their financial health, how they stack up valuation-wise.
And I hear we might even play with some paper money.
We will. Just some fun scenarios, to illustrate potential outcomes based on historical data.
Yeah.
But before we dive into any numbers.
Yes, the important part.
Crucial note here.
Yeah.
Everything we discussed today, it's strictly for educational and informational purposes. It's all based on the sources you gave us.
So not financial advice.
Absolutely not. It shouldn't be taken as financial advice. Investing, as carries inherent risks.
And past performance.
Doesn't guarantee future results. Always, always do your own research. Talk to a qualified financial advisor before making any investment decisions.
Okay, critical foundation laid. Let's jump in. First up, United Parcel Service, UPS.
The Titan.
A behemoth, really. When you think logistics, they're often top of mind. Market cap, over $72 billion. Huge. But scale alone doesn't tell the whole story, does it?
Not at all. UPS is, a classic USA-based company, firmly in that integrated freight and logistics space.
Yeah.
Sources put that market cap at $72.21 billion. And they have a massive workforce, roughly 490,000 employees globally.
Wow.
NYSE-listed, S&P 500 member. It underscores their market presence, their stability, really.
Okay, let's unpack the recent performance then. The technical side for UPS. Well, it looks like they've been navigating some serious headwinds.
That's putting it mildly.
Right. A tiny bump last week, 0.95%. But zoom out. Down 3.71% last month. Down 15.72% for the quarter, year to date. Down over 32%.
Ouch.
And the full year. Down 33.66%. Even 5 years back, it's down 46.68%.
That's significant underperformance.
It really is. The stock's trading around $85.20 right now, very close to its 52-week low of $82.
A long way from its high.
A stark contrast to that $145.01 high, yeah.
And the moving averages. They confirm that bearish picture unequivocally.
Below all the key ones?
Consistently below. It's trading under its 20-day SMA by 0.83%, the 50-day by 6.20%, and the 200-day by a hefty 20.05%.
So not just a blip.
No, this confirms a deeply entrenched downtrend. And the RSI, the Relative Strength Index, it's at 42.47.
So not oversold yet?
Not technically oversold, no. Which means we aren't seeing that extreme panic selling that sometimes precedes a bounce. It's more like sustained weak interest.
Okay, so given this persistent downtrend, how should we think about hypothetical buy and sell triggers if someone were looking at UPS?
Right. Well, for a hypothetical buy, the fact it's hovering near that 52-week low, or if the RSI dipped below 30 into truly oversold territory.
That might attract some bargain hunters.
Theoretically, yes. Some contrarian investors might see a potential rebound play there. But you'd need real conviction, a clear sign things are turning around.
And on the flip side, a sell trigger.
Honestly, for someone already holding, a theoretical sell trigger probably flashed much earlier in this decline.
Like breaking below those moving averages.
Exactly. A decisive breach below those key SMAs, or maybe a prior support level giving way, that would have confirmed the negative momentum shift.
Makes sense. Now, to really feel the impact of these moves, let's crunch those paper money numbers you mentioned.
Okay, let's do it. Imagine, hypothetically, you invested $10,000 in UPS right near its 52-week low of $82.
Okay.
That $10,000 would have snagged you approximately 121 shares.
Right.
Now, at today's closing price of $85.20, those 121 shares, they'd theoretically be worth $10,309.20.
So a small profit.
A paper profit, yes.
Yeah.
About $387.20, or a 3.90% gain. It shows, even in a downtrend, catching the absolute bottom could yield a short-term gain.
But timing that bottom is the tricky part.
Extremely tricky.
Now, beyond the charts, the news often paints a picture. And for UPS, it seems like, well, a real mixed bag recently.
Definitely some conflicting signals.
On the negative side, BofA Securities downgraded UPS to sell. That was September 11th. That's a big call.
A major analyst weighing in negatively, yeah.
Then, just a day later, Jim Cramer apparently raised concerns about UPS's high dividend yield, questioning its sustainability.
which ties into financial health, something we'll touch on.
And then there's this broader issue, this surprise tariff bill impacting online shopping, affecting carriers like FedEx and UPS. That was flagged mid-September.
Yes, sector-wide regulatory headwinds. Those can bite.
But it wasn't all bad news, right?
No, not entirely. UPS managed to avoid that Teamster strike back in August. That was huge, a massive operational relief.
Definitely dodged a bullet there.
And perhaps more interestingly, the CEO, Carol Tomé, actually bought shares on August 8th.
Oh, insider buying, even with the stock trending down.
Exactly. Amidst all the negative analyst sentiment and the clear downtrend, you have the CEO putting her own money in. It's an interesting counterpoint.
That is interesting. So we have this downtrend, analyst downgrades, but the CEO's buying. How do you square that? Is that a strong contrarian signal, or...
It's a great question. Look, insider buying can be powerful. It suggests leadership sees value the market isn't recognizing. Maybe a belief in a longer-term turnaround.
But it's not a guarantee.
Definitely not.
Yeah.
One insider's buy, even the CEOs, doesn't automatically cancel out sector slowdowns, downgrades, or tariff issues. It might hint at potential long-term value, but the current challenges are very real. It's a complex signal, something to note, not necessarily a simple buy now flashing light.
Okay, that makes sense. Let's dig into the financials and valuation then.
Financially, UPS, being mature, reported income of $5.73 billion. Sales were substantial, $90.16 billion.
Solid numbers.
Yeah, trailing 12-month EPS is $6.73. Expected next year, around $7.20. But here's a metric that jumps out. That dividend payout ratio.
The one Kramer mentioned.
Potentially related, yeah. It's at 96.41%, extremely high.
Wow, 96%.
Yes, which is great for current dividend seekers, but it's strategic constraint. It leaves very little cash flow for reinvestment.
Like in new tech, AI, things competitors might be doing.
Precisely. It could make them vulnerable if they can't invest aggressively in innovation. Now, their return on equity is strong, 34.96%, good use of shareholder money.
Yeah.
But return on assets, 8.17%, and return on invested capital, 13.32%, are lower compared to maybe more asset-light or tech-focused peers.
Meaning their massive infrastructure might not be generating as much profit relative to its size.
Potentially, yeah, or just the cost of maintaining that scale. Their debt-to-equity is also relatively high at 1.84, more leverage.
So putting it all together, what's the valuation story, especially with growth seeming slow?
Well, the PE ratio is 12.67, forward PE is 11.83. On the surface, that looks relatively low, maybe even cheap.
Okay.
But you have to look at the PEG ratio, price earnings to growth. That compares the PE to expected growth.
And for UP?
It's 9.25, exceptionally high. Generally, under 1.0 is seen as potentially good value.
So 9.25 means?
It means investors are paying a very, very steep premium for very slow projected long-term growth. EPS growth expected next 5 years, just 1.37%.
Yikes. So potentially overvalued relative to its growth prospects, despite the low PE.
That's what the PEG suggests, yes.
Yeah?
So UPS, a mature giant facing headwinds, balancing dividends versus reinvestment. Analysts are cautious, but the CEO showed some faith. A complex picture.
Very complex. Okay, that's a thorough look at UPS. Now let's completely shift gears. C.H. Robinson Worldwide. CHRW.
A totally different vibe recently.
Right. Different scale than UPS, market cap around $15.8 billion, but clearly making waves in the logistics landscape with a very different recent story.
Absolutely. Another U.S.-based player, integrated freight and logistics. That $15.8 billion market cap, about 13,781 employees. NASDAQ listed, S&P 500 component too.
And their focus.
Their core is really freight transportation logistics solutions. Big segments are North American surface transportation, NAST, and global forwarding.
Okay, now the technicals for CHRW. Wow, it's night and day compared to UPS. This stock's been on an absolute tear.
It really has. Incredible momentum.
Past week, up over 6%. Past month, over 10%.
Strong.
And the quarter, get this, up 42.52%.
Remarkable run.
Year to date, it's gained nearly 30%, and over the last year, up 34.50%. The price now, $133.77, is basically kissing its 52-week high of $134.91.
Way up from its low.
Massively up from that $84.68.
And the moving averages, they screen strong uptrend. Price is comfortably above the 20-day SMA by 4.76%, the 50-day by almost 16%, and the 200-day by nearly 30%.
All systems go, technically speaking.
Almost. There's one indicator of flashing caution, the RSI 14. It's at 77.45.
Which is?
Firmly in overbought territory. Anything over 70 is usually considered overbought.
Meaning it might be due for a breather.
A pullback. While the momentum is undeniably strong, that IRSI suggests buying pressure has been intense, and a short-term correction wouldn't be surprising.
Okay, so for a stock like this, amazing momentum but flashing overbought, how do you think about hypothetical triggers?
Well, hypothetical buy trigger would likely have been much earlier, maybe when it decisively broke above the 50-day or 200-day SMA, signaling that uptrend was starting.
But now,
Now with the stock near its high and that RSI over 77, it actually suggests a potential theoretical take-profit point for those who got in lower.
anticipating that pullback.
Right. For someone looking to get in now, hypothetically, waiting for a consolidation period or a dip from these overbought levels might seem more prudent. Chasing here could be risky.
Understood. Let's illustrate the power of touching that trend with the paper money math for CHRW.
Okay, this one's more dramatic than UPS. Hypothetically, invest $10,000 in CHRW near its 52-week low of $84.68.
Right.
That would get you about 118 shares.
Mm-hmm.
Hold those shares until today's close at $133.77. Your $10,000 investment is now theoretically worth $15,784.86.
Wow.
That's a paper profit of roughly $5,792.62, an impressive 57.97% gain.
That really shows the potential reward of strong momentum.
It certainly does, if you catch it right.
Now, the recent news for CHRW seems to explain why it's been soaring. It sounds just as compelling as the stock chart.
The narrative aligns well with the performance.
It was on Benchmark's Best Idea list for 2025. They've rolled out new services like cross-border freight consolidation, and a huge theme seems to be AI, right?
Absolutely. They launched an always-on logistics planner. They're integrating AI into their 4PL arm. This isn't just talk. It seems like a real strategic push.
And it's translating to results.
Apparently so. Strong Q2 earnings beat estimates. The commentary mentioned improved profitability, productivity, and a lot fewer workers.
Efficiency gains paying off.
Exactly. Signals success in cost management, even if overall revenue growth was a bit soft. And analysts have noticed a series of upgrades through 2024 and 2025, growing confidence there.
Okay, but wasn't there something about insider selling?
Ah, yes. Good point. While the overall sentiment is positive, sources did note some proposed insider sales in August 2025.
Anything significant?
One stood out. A director, Winship Henry Ward IV, proposed selling shares worth over $34 million.
$34 million, that's considerable.
It is. It's a detail investors would definitely watch. It contrasts with the bullish upgrades and raises questions about how insiders view the valuation at these higher levels.
So that overbought RSI, plus significant insider selling, even with the great news, are those warning signs the market might be getting ahead of itself?
It's a very fair question. The RSI does suggest a short-term correction is plausible, even if the long-term story is intact.
And the selling?
Well, insiders sell for many reasons, not always negative. But a large proposed sale by a director near peak prices. It warrants attention. It could imply some insiders feel it's richly valued right now, perhaps limiting the immediate upside.
Something to keep in mind. Okay, let's look under the hood. CHRW's financials and valuation.
Financially, income was $534.31 million on sales of $17.01 billion. EPS TTM is 4.39 cents. Expected next year, $5.57. That's a healthy jump.
And you mentioned sales were down, but EPS was up.
Correct. Sales QQ and YYTTM were negative, but EPS QQ growth was nearly 20%. That really highlights their focus on efficiency and cost control driving profits.
Impressive management.
Seems so. Return on equity is strong at 32.43%. ROIC at 17.98%. Shows good capital efficiency. Debt to equity is moderate at 0.95.
So how does that translate to valuation, given the stock's run-up?
The valuation definitely reflects the optimism. PE is higher at 30.45, forward PE at 24.03. That's baked into the strong performance and growth expectations.
And the PEG ratio.
Also higher at 3.36. Compared to that ideal benchmark around 1.0, it suggests investors are paying a premium for the expected growth.
So a growth premium built in.
Exactly. CHRW looks like a company executing very well, using tech and efficiency to drive performance. But those technical warnings and insider sales add a layer of caution to the current picture.
Okay, fascinating contrast between UPS and CHRW. Now let's bring in our third player, FedEx, FDX.
Right, another household name.
Sitting between the other two in size, market cap around $53.7 billion. Where does FedEx fit in this evolving landscape?
Well, FDX is another U.S.-based giant in integrated freight and logistics. That $53.73 billion market cap, NYSE listed, S&P 500 member.
And their business.
Very broad. Transportation, e-commerce, business services globally, a critical piece of the worldwide supply chain facing many of those same industry pressures.
Okay, technically, how's FedEx looking? Its performance seems, well, a bit more muted than CHRW, but maybe not as negative long-term as UPS.
That's a fair summary. Short term, it's been pretty flat. Up less than 1% over the week, month, and quarter.
But longer term?
Still negative. Down about 7% over 6 months, 19% year-to-date, and 20% over the past year.
Where's the price now relative to its range?
Trading at $227.70. That's about 17% above its 52-week low, $194.29. So it has recovered somewhat.
But still well off its high.
Significantly. Still down about 26% from its 52-week high of $308.53.
And the moving averages?
They suggest some slight weakness or consolidation. Price is just under the 20-day SMA, -0.39%, the 50-day, -0.80%, and the 200-day, -5.8%.
So struggling to break higher.
Or just lacking strong upward momentum right now. The RSI 14 confirms this neutrality. It's at 49.45. Neither overbought nor oversold.
Right in the middle.
Pretty much. Also, its beta is 1.29, meaning it tends to be a bit more volatile than the overall market.
Okay, given that neutral stance, what about hypothetical triggers for FedEx?
Well, with that neutral RSI and being well off its highs, maybe a wait-and-see approach for many. A hypothetical buy signal. Perhaps if it dropped closer to that 52-week low and the RSI became oversold, that could signal a potential bounce opportunity.
And a sell trigger.
Not much immediate pressure from the technicals alone. It's not overbought or near highs. A theoretical sell might come if it broke below a key support level or if significant negative news hit. But the charts themselves aren't screaming sell right now.
Let's do the paper math for FedEx, investing near the lows.
Okay. Hypothetical $10,000 investment near the 52-week low of $194.29.
Yep.
That gets you about 51 shares.
Got it.
At today's close of $227.70, those 51 shares are worth $11,612.70.
So a decent recovery from the low.
Yeah, a paper profit of $1,703.91. That's a respectable 17.19% gain off the bottom. Shows a solid recovery there.
Now, the news for FedEx, it shares some of those tariff concerns with UPS, right? That de minimis rule potentially ending?
Yes, that's a sector-wide cloud hanging over them, mentioned around September 16th. BofA Securities also hit FedEx with a downgrade, though less severe than UPS, down to neutral on September 11th.
But FedEx seems to be making proactive moves, too.
They are. They announced a 5.9% rate hike and higher surcharges coming in 2026. That's a clear move to boost revenue, announced September 12th.
Strategic pricing power.
Trying to leverage it, yes. And leadership changes are happening. Vishal Talwar appointed Chief Digital and Information Officer in August. That signals a strong focus on digital transformation.
Which seems crucial these days.
Absolutely. On the less positive side, there were reports of layoffs, 611 workers tied to a shift in Cummins distribution, announced early September, so ongoing adjustments there.
And any insider activity like the others?
Yes. Sources noted several insiders, including directors and the executive chairman, exercising options and selling shares throughout 2025. Similar pattern to CHRW, some executives taking money off the table.
Okay, let's look at FedEx's financials and valuation then.
Financially, income was $4.09 billion on sales of $87.93 billion. EPS, TTM, is 16.86 cents, with a strong expected jump next year to $21.27.
That's a good forward expectation.
It is, and notably, their EPS growth over the past 5 years was robust, averaging almost 28% annually. So, solid track record there.
Sales growth more modest, though.
Yes, YYTTM sales growth was only 0.27%, quarterly 0.50%. Suggests efficiency and maybe pricing are key profit drivers. Margins look solid. Gross margin 21.60%, profit margin 4.65%. Debt to equity is moderate at 1.33.
So connecting that all together, how does the valuation look, especially compared to UPS and CHRW?
This is where FedEx gets interesting from a valuation perspective. The PE is 13.50, forward PE is 10.71. Both look quite attractive.
Lower than CHRW, similar to UPS's PE, but with better growth.
Exactly. And the PEG ratio really highlights this. It's 1.46.
Still above 1.0, but much lower than the others.
Much lower. Remember, UPS was over 9, CHRW over 3. FedEx at 1.46 looks quite favorable, suggesting its strong expected growth might be available at a more reasonable price relative to its earnings multiple. It potentially looks undervalued compared to peers based on that PEG.
So potentially the value growth play among the three.
You could argue that based on these metrics, yes. Promising valuation, good historical EPS growth, But it still faces those sector headwinds, mixed analyst views. They're focused on digital, and those rate hikes will be key to watch.
Wow, okay. What an insightful deep dive across these three logistics giants. We've really seen a spectrum, haven't we?
The huge specs.
UPS, high yield, insider buys, but wrestling with a downtrend and that tricky dividend payout ratio.
A mature company facing challenges.
And CHRW, incredible momentum driven by AI and efficiency, but flashing overbought signals and seeing some insider selling.
The high flyer with caveats.
And finally, FedEx. Presenting those attractive valuation metrics, a good growth story relative to price, but still dealing with sector headwinds and making big bets on digital and pricing.
A more balanced, perhaps value-oriented picture right now.
Each one presenting such a unique profile in this vital sector.
It really raises a crucial question, I think, for you, the listener, to ponder. In this rapidly evolving logistics world hit by tariffs, transformed by AI, shaped by labor dynamics, how will these companies balance their huge legacy operations with the absolute need for agile transformation?
That balance seems key.
It does. The sources clearly show everyone's trying to adapt with tech, manage costs meticulously. Ultimately, that strategic agility, how they allocate capital, is likely going to define who succeeds and, frankly, where the investment value lies in the coming years.
So what truly stands out to you from this deep dive? We really hope this has given you a clearer, more nuanced picture of this vital sector and these fascinating companies.
Keep digging, keep asking questions.
Absolutely. Keep learning, keep asking questions, and we'll be right here to help you unpack more insights next time.